Andrew Carnegie famously said 90% of all millionaires become so through owning real estate. It's this huge, motivating quote for people.
It definitely is. But when people hear owning real estate,
Yeah, they immediately think landlords, right? Tenants and toilets at those late night calls, plumbing nightmares.
exactly. It sounds like a lot of work, not exactly passive income.
Not at all.
How-
And that traditional path, owning property directly, it is active, very active.
Takes time, effort, definitely a lot of patience for those unexpected issues. But that Carnegie quote, it hints at something deeper, right?
Yeah, the power of real estate just as an asset class, whether or not you're the one fixing the leaky faucet.
Precisely. And that's what we're really digging into today.
We're going beyond the usual suspect, the publicly traded REITs, real estate investment trusts.
Yeah, we've been looking through a whole stack of material you provided. Research papers, investor articles, forum discussions.
Yeah.
Really exploring these other passive routes. Things like real estate notes, syndications, different kinds of funds.
Yeah. So our goal here is to kind of lay out the map for you, help you understand why investors are looking at these alternatives.
What the options actually are, what are the upsides, the downsides.
And crucially, what you really need to think about before, jumping in. Consider this your fast track to getting up to speed on passive real estate wealth building without the landlord headaches.
Let's unpack it. So, first things first, why is passive real estate investing even a thing? Why is it so attractive, especially to, say, more sophisticated investors?
Right. It's more than just avoiding the property management hassle.
Definitely. A big reason, something that came up again and again in the sources, is the nature of the asset itself. It's real.
Tangible, unlike stocks, which are sort of a bet on future earnings.
Exactly. With real estate, your money is tied to a physical thing, an apartment building, a self-storage facility, land.
Or even if you're investing in the debt, like a mortgage note, it's still secured by that physical property, right? A legal claim.
That tangibility, it offers a kind of psychological comfort, maybe, a grounding compared to purely financial assets.
Yeah, I get that. And the numbers seem to back it up historically.
They do. We found this really interesting Fed research paper, San Francisco Fed. They look at asset performance over 150 years, 1870 to 2015.
Wow, that's a long time frame.
Incredible, right? And the finding. Real estate came out as the best performing asset class over that entire period.
The best. Over 150 years, that's significant.
It really is. It suggests something very durable about its wealth generating power.
And what about risk? People often think real estate is safer, but is it?
Well, the same study also looked at volatility. How much prices swing up and down.
Right. Bigger swings generally mean more risk.
Exactly. And historically, real estate was found to be significantly less volatile than the stock market.
Right.
So what that means for an investor is potentially better risk-adjusted returns. You might get good returns, maybe even better than stocks long-term, but with a smoother ride, less whiplash.
That makes intuitive sense. House prices don't usually crash 20% overnight like a stock can on bad news. Usually.
Generally, yes, unless there's a very specific local issue. And this isn't just theory. The sources mention groups like Tiger 21.
Oh, yeah, the network for ultra-high net worth individuals.
Right. Average member managing over $100 million. And their single largest asset allocation. It's real estate, often passive real estate.
So the people with access to basically any investment are heavily weighting real estate.
They clearly see its value for both growth and preserving wealth.
Okay, so we have historical performance, lower volatility, tangible assets. The big money is doing it. What's changed recently to make this more accessible? Because it wasn't always easy for smaller investors, was it?
No, not at all. That's the democratization piece that's happened over, say, the last decade or so.
Meaning,
while a lot of the really big institutional deals are still mostly for accredited investors.
Let's quickly define that accredited investor.
Sure. It's an SEC definition. Generally, it means someone with an income over $200,000 single or a $300,000 joint for the last 2 years, or a net worth over $1 million, not including their primary home.
Okay, so those folks still have more access, but
things like real estate crowdfunding platforms, more streamlined syndication processes, they've opened the doors. Minimum investments have come down. You don't necessarily need millions to buy a piece of a larger passive deal anymore. You can pool your money.
Right. Okay, that sets the scene. Let's get into the actual types of assets you can invest in passively. The sources broke them down into 3 main groups.
First one, the most familiar, is residential. Single-family homes, duplexes, apartments.
It's stuff we live in.
Pretty much.
Yeah.
But passively, this could mean investing in, say, an apartment building syndication, or like we mentioned, buying the debt.
Buying the mortgage note, becoming the bank.
Exactly. You buy the loan, you collect the payments. And for residential property, the key value driver is usually comparable sales. What have similar homes nearby sold for recently? That sets the price.
Okay, comps for residential. What's the second bucket?
Commercial real estate. And this category is way broader. It includes, well, a lot.
Like?
Multifamily apartment buildings, probably the most common for passive investing, outside of maybe notes. Then you have retail, industrial warehouses, office buildings, hotels, self-storage, mobile home parks, even things like farmland, senior housing, student housing.
Wow, yeah, that's diverse. Each must have its own, market dynamics.
Totally different. And the big difference from residential valuation. Commercial value is driven primarily by income. How much money does the property generate?
This is where cap rates come in, right? Capitalization rate.
Exactly. The cap rate. Let's make sure we're clear on that.
Yeah, define it simply.
Okay, simply put, it's the property's unleveraged yield. You take the net operating income, or NOI.
Which is revenue minus operating costs before debt payments.
Right. You take the NOI and divide it by the property's price or value. So a higher cap rate means more income relative to the price.
Suggesting maybe a higher return, but maybe also higher risk, or a less desirable asset.
Could be. It's a snapshot. And with commercial, especially for longer-term passive holds, you really need to think macro. What's happening with jobs, population shifts, e-commerce trends impacting retail versus industrial? Those big picture factors are crucial because they drive supply and demand for that specific type of commercial space.
Got it. So residential uses comps, commercial uses income, and cap rates. What was the third category?
The third was just a miscellaneous bucket for niche strategies.
Yeah.
The sources mention tax liens, buying the liens municipalities put on properties for unpaid taxes. You're secured by the property, might get penalty interest. And also raw land, undeveloped land, usually a very long-term bet on appreciation or future development. Doesn't typically generate income while you hold it.
Okay, clear. Assets covered. Now, how do these assets fit into the strategies that operators use? The sources laid out 5, kind of on a risk-return spectrum.
Yeah, this is key to understanding what the operator, the person you're investing with passively, is actually planning to do with the asset. It ranges from highest risk, highest potential return down to lowest risk, lowest return.
Let's start at the top. High risk, high reward. What's strategy number 1?
That's distressed real estate.
Buying troubled assets.
Exactly. Properties with big problems. Maybe they're physically falling apart, terribly managed. Owners are in financial trouble, legal issues. The idea is you buy them cheap, below their potential value because of these problems.
Sounds like you're buying headaches, hoping to turn them into profit.
That's a good way to put it. And these opportunities often pop up more during economic downturns. When there's more financial stress out there. Countercyclical?
Makes sense. But the risk must be huge. You're betting you can actually fix those deep-seated problems. The operator's experience here must be absolutely critical.
Non-negotiable. You need a sponsor with a proven track record in turnarounds. Your investment rides entirely on their ability to execute that fix-it plan.
Okay, moving down the risk scale a bit. Strategy 2.
Development. Building something brand new from scratch.
Ground-up construction.
Right. An operator sees a market need, maybe more warehouses or senior living. They buy the land, get permits, manage the whole build. This tends to do well when the economy's booming. Pro-cyclical?
Building new sounds risky too, just in a different way. Long timelines, lots of variables.
Definitely. You've got market risk. Will people still want this thing when it's finally built years later? Interest rate risk. What if borrowing costs shoot up mid-project? Construction costs risk. Lumber prices go crazy. Labor shortages. And plan approval risk. Getting permits and zoning can be a nightmare.
Lots of hurdles, but potentially big rewards if it works out.
For sure, if you deliver the right product at the right time.
Okay, third strategy. Opportunistic. What's that involve?
This is about taking an existing property and changing its fundamental use, repositioning it.
Like turning an old office building into apartments.
Exactly that kind of thing. Or maybe converting a struggling shopping mall into a logistics center, or mixed use. Adapting to big market shifts.
So capitalizing on trends like remote work hitting offices or e-commerce boosting warehouses.
Precisely. And often, renovating an existing structure is cheaper than building totally new, which can create a profit margin. Still, high potential returns, but again, you need a sponsor who really understands both the original asset and the new use they're targeting. Complex transformations.
Gotcha. Now, the sources said the fourth strategy is where most passive opportunities tend to fall.
Right. value add. This is probably the most common one you'll see in syndications or funds.
And the goal here is
To take an existing property that's maybe just underperforming, not totally distressed, but maybe dated, poorly managed, rents are below market, and make specific improvements to boost its income. Increase the NOI.
so not a gut renovation necessarily, but optimizing what's already there, fixing inefficiencies, making cosmetic upgrades, maybe managing it better.
Exactly. Reducing expenses, increasing revenue. That apartment example from the source material really nails this.
Yeah, walk us through that again. It was a great illustration.
Okay. So this owner buys an apartment building and it has these large, kind of awkward 3-bedroom units.
Okay.
But they realize the market demand is actually much stronger for smaller 1-bedroom units. The 3 bedrooms are renting for, say, $875 a month.
Right.
So the owner renovates. They cleverly reconfigure the space within each 3-bedroom unit to create 2 separate 1-bedroom units.
Splitting the larger space.
And each of those new 1-bedroom units can now rent for $600.
So $600 plus $600, that's $1,200 a month from the same square footage that used to bring in $875.
Exactly. A $325 per month increase per unit they converted. Multiply that across multiple units in the building.
Wow, that adds up fast.
It does. The source estimated this kind of strategic renovation created something like $2 million in extra value on what was initially a $10 million property. That's value created directly by the operator's actions, not just waiting for the market to go up.
That's the value add. Makes total sense. Okay, and the last strategy, lowest risk.
Lowest risk, lowest potential return, generally. That's core.
Core investing. What does that look like?
Think high-quality, stable, almost trophy assets in prime locations. Like that example of a fully leased beachfront apartment building in Miami or a top-tier office tower in a major downtown.
They're really nice, established property.
Right. They're usually well-maintained, have stable tenants, generate predictable income. The goal here is mostly capital preservation and steady cash flow, not hitting a home run with appreciation or development. Low drama, low yields, relatively speaking.
Okay, that spectrum of strategies is super helpful. Distressed, development, opportunistic, value add, core. Now, when we, as passive investors, put money into these deals, how is it structured financially? This is where the capital stack comes in, right?
Yes, and understanding this is absolutely fundamental. You have to know where you sit in the capital stack.
Because it determines who gets paid first and how much risk you're taking.
Exactly. It shows how the property is financed the layers of debt and equity and dictates the payment order. Risk and return are directly tied to your position.
So break down the layers for us. What's at the bottom, the safest spot?
At the bottom, first in line to get paid is debt. Usually senior debt like the main mortgage from a bank.
The lender.
Right. They get their principal and interest payments before anyone else touches the cash flow. Because they have the first claim and are secured by the property, they have the least risk. Institutional investors often like this position. Yields are typically lower, unless maybe it's distressed debt bought cheaply.
Okay, debt gets paid first. What's the next layer up?
Above senior debt, you often find preferred equity.
Pref equity.
Yeah. It's junior to the debt, meaning debt gets paid before pref, but it's senior to the common equity. Pref equity holders get paid after the lender, but before the common equity investors see any money.
And how do they get paid? Is it a fixed rate?
Often, yes. They might get a fixed preferred return, maybe 8% or 10% per year, before any profits are split with the common equity.
So a bit more yield than senior debt, still paid before common equity. Less risky than common equity.
Generally, yes. But the trade-off is their return is usually capped. They get the preferred rate, but they typically don't share in the extra upside if the project really knocks it out of the park.
Got it. So debt first, then preferred equity. What's at the very top?
At the top, taking the most risk is equity, usually common equity.
The owners, essentially. Or the main risk takers.
The main risk takers. They are last in line for payments.
Only after debt and pref equity are fully paid off.
Correct. They're betting on the project's overall success, the appreciation, the big profit at the end. If the deal does great, common equity holders make the most money because they get everything that's left over.
But if it goes bad?
They lose first. If the property has to be sold at a loss or in foreclosure after the debt and pref equity are paid, there might be zero left for common equity. High risk, high potential reward.
And this whole payment order is governed by the cash flow waterfall.
That's the term, yeah. It's just a set of rules in the agreement that spells out exactly how cash flows from rent or proceeds from a sale get distributed down through those layers of the capital stack. Debt, then pref, then common equity, potentially with various splits and hurdles along the way.
Okay. So When you're looking at any passive deal, what are the absolute must-ask questions related to this?
3 critical ones highlighted in the sources.
Yeah.
1, where am I in the capital stack? Debt, pref, or common equity. 2, how do I get paid? Fixed interest, preferred return, profit split, what's the structure? And 3, when do I get paid? Monthly, quarterly, only at the end when it sells.
Knowing those answers tells you your risk and reward profile in that specific deal.
Absolutely. Non-negotiable homework.
Right. We know why passive, the assets, the strategies, the financing stack. Now let's talk about the vehicles. How do you actually invest? We said we're going beyond public REITs.
Right. Public REITs are the easy entry point, trading like stocks, offering liquidity diversification initially. But they have drawbacks we mentioned.
Yeah, they can track the stock market too closely, defeating the diversification purpose sometimes. And the tax benefits aren't the same as direct ownership.
Exactly. Which leads investors to the private side,
Yeah.
often called alternative investments or alts.
Where you're investing directly with the operators.
Directly with the sponsors running the deal, which means trust in that sponsor, their strategy, their track record becomes absolutely paramount. The 2 main structures here are syndications and funds.
Okay, let's break down syndications. How does that work for me as a passive investor?
In a syndication, a sponsor, they're called the general partner or GP, finds a deal, usually a single large asset like an apartment complex or a hotel that needs work.
Something too big for one person to buy alone.
Right. The sponsor puts the deal together, figures out the business plan, and then raises money from a group of passive investors who are called limited partners or LPs.
So the LPs provide the capital, the GP does all the work, acquisition, management, renovation, eventual sale.
Precisely. The syndication is set up for that specific property with a specific plan, or usually a target time frame, maybe 3 to 7 years, sometimes longer.
What are the main attractions of doing a syndication? The pros?
Well, access. You get into these bigger, potentially institutional quality deals you couldn't touch on your own. There's the potential for passive income, cash flow distributions, maybe quarterly. Not guaranteed, but potential.
And the tax benefits.
That's a big one. The pass-through tax advantages, especially depreciation, can shelter a good chunk of that cash flow from taxes. That's a key difference from public REITs. Plus, you can diversify by investing in multiple syndications across different properties or locations. And, importantly, you usually know the exact asset you're investing in beforehand. You see the property, the plan.
That visibility is good. What about the cons? The risks of syndications?
Big one is lack of control. As an LP, you have basically zero say in the day-to-day decisions. The GP calls the shots. They're also highly illiquid. Your money is locked up for the life of the project. Getting out early is very difficult, maybe impossible.
And the sponsor risk?
Huge. Your success is almost entirely dependent on the GP's competence, honesty, and execution ability. You have to do deep due diligence on the sponsor, their track record, talk to their past investors if you can, and watch out for conflicts of interest. Make sure the fees and profit splits align their interests with yours. Read the fine print on fees acquisition, asset management, disposition, the profit split, promote.
So vetting the sponsor is just as important, maybe more important, than vetting the property itself.
I'd argue yes in many cases.
Oh.
Okay, now how do funds differ?
Funds also pool investor money, right? But not for just one property.
Correct. A fund raises capital to buy a portfolio of assets, usually fitting a specific theme. Like a fund might focus only on value-add multifamily in the Sun Belt or distressed commercial debt nationwide.
The sources called them blind pools sometime.
Often, yeah. Especially closed-end funds. Because when you invest, you might not know the specific properties the fund will end up buying. You're investing in the sponsor's strategy, their expertise, their deal pipeline, and their underwriting criteria. You trust them to go find the deals.
So less visibility into the specific assets compared to a syndication.
Definitely.
Yeah.
Which means you need even more trust in the fund manager's track record and ability.
What's the main advantage of a fund structure then?
Diversification. Right off the bat, your investment is spread across many assets. If one property has issues, it doesn't sink your whole investment like it could in a single asset syndication. It potentially lowers your risk profile.
Makes sense. Disadvantages besides the lower visibility.
Still illiquid, like syndications. Fees can also be layered fees at the fund level, potentially fees at the property level too, and again, requires immense trust in the sponsor.
Are there different types of funds?
Yeah, mainly closed-end and open-end. Closed-end funds raise money for a set period, close to new investors, deploy the capital, run the strategy, and then eventually liquidate and return capital over a defined life, say 7 and 10 years. Open-end or evergreen funds aim to be continuously open, taking in new money and deploying it, potentially buying and selling assets indefinitely. The fund mentioned in one source operates like this.
Okay. Syndications for one asset, funds for many, both private, illiquid, sponsor-dependent. Let's move to the third private option, real estate notes. The Reddit thread you sent had some really raw detail on this.
Yeah, notes are interesting. Less common for the average passive investor, maybe, but basically you're buying debt.
The mortgage.
You buy the promissory note the borrower's promised to pay, and the mortgage or deed of trust, which secures that promise with the actual real estate. You become the lender.
And the borrower sends their monthly payments to you.
Or more likely, to a loan servicer who manages it for you. But yes, the payments flow to the note holder.
So the appeal is getting that income stream without landlord duties.
That's the big draw. Passive income, potentially. Your investment is secured by the property. If the borrower defaults, you have a legal claim to the asset. And the sources suggest you can get potentially high, consistent income, especially if you buy notes at a discount to what's owed. It's another way to get real estate exposure, maybe diversify across different types of loans or locations. You're the bank.
Acting as the bank sounds good, but that Reddit discussion made it sound like it can get really messy if things go wrong. What are the big risks?
Yeah, passive gets tested here. The number one risk is borrower default. Plain and simple, they stop paying.
Income stops. And then
Then you're facing a potentially long, expensive, and complicated process to try and recover your money, likely involving foreclosure.
so the due diligence isn't just on the property, it's heavily on the borrower too.
Absolutely critical. You need to understand their creditworthiness when the loan was made. What was their credit score, income, job history, debt-to-income ratio, DTI, lower is better, and the loan-to-value ratio, LTV. How much equity did they have? Lower LTV gives you more cushion if values drop or you have foreclosure costs. You'd want to see the original application appraisal if possible. The Reddit thread cautioned about buying deeply discounted notes. You need to know why it's discounted. Is there a hidden problem?
What about the property itself?
That matters too. Real estate depreciation. If the property value tanks after you buy the note, foreclosure might not even recover your investment, even if you had a decent LTV initially. Property condition also affects how easy it is to sell if you do take it back.
And the foreclosure process itself, the Reddit thread made it sound like a nightmare.
It can be. The complexity and cost of foreclosure is a huge factor people underestimate. It's a legal battle, varies wildly by state, some faster, some incredibly slow and bogged down in courts. It costs money. Lawyer fees, court fees, maybe paying taxes and insurance on the property while it's ongoing, maintenance, selling costs. And borrowers have ways to delay it. Bankruptcy, loan mods, legal aid. It can drag on for months, even years.
Yikes. And you don't just automatically get the property cheap.
No. Your goal is to recover your outstanding loan balance from the sale. After paying any lands ahead of you and all the costs, you get what's left, up to what you're owed.
What about interest rates moving? Does that affect notes?
Yep, interest rate fluctuations. If rates rise after you buy a fixed-rate note, your note might be worth less if you try to sell it. If rates fall sharply, the borrower might refinance, paying you off early. Your nice income stream disappears, and you have to reinvest maybe at lower rates. The sources called it cash flow drying up.
And economic downturns.
Recessions make everything worse. More job losses mean more defaults. Property values might fall too. Double whammy.
Any other sneaky risks with notes?
Definitely. Title issues and other lynches.
Eh.
You need a clean title search. Are there older mortgages, mechanics lynches? The Reddit thread specifically mentioned IRS liens or HOA super priority liens in some states that can actually jump ahead of your mortgage in a foreclosure. That's bad news. Regulatory changes in lending or foreclosure laws can impact things, and natural disasters got to make sure the property insurance is solid.
Wow. It sounds like the due diligence for notes is maybe even more intense than for an equity deal like a syndication. You're vetting the borrower, the property, and the legal framework.
It's a different type of due diligence for sure. You need to verify the borrower's profile and payment history. Get a current property valuation, appraisal or BPO. Do that title search, confirm the loan docs are legally sound and compliant. Understand the state's foreclosure process inside out. Know your exit strategy if you foreclose. Review every detail of the loan terms. And understand who's servicing the loan, collecting payments, handling escrow, talking to the borrower, and what they charge.
Yeah, that is a lot. This isn't just clipping coupons passively. It's either a ton of upfront work or you really need to trust who's doing it for you.
Exactly. Which is why, for most truly passive investors, getting into notes is probably best done through experienced note funds or specialized platforms. They have the teams and systems to handle the sourcing, underwriting, servicing, and importantly, the defaults and foreclosures. Some platforms are now offering diversified pools of first lien mortgages, making it more accessible.
What about that weird Reddit example where the remaining balance seemed higher than the total remaining payments?
Yeah, that was odd for a standard mortgage.
Yeah.
Could have been a data error, maybe an unmentioned balloon payment. But the lesson there, as people pointed out, is you absolutely must scrutinize the original loan docs and amortization schedule yourself. Don't rely on summaries. It perfectly shows why deep diligence on the specific loan is vital.
So for notes, your exit is either hold to maturity, sell the note, or for foreclose. And the interest income is generally taxed as ordinary income.
That's right. And again, the legal side, foreclosure, compliance, super complex. Get professional advice.
Okay, that was a thorough look at notes. Stepping back, across all these private passive options, syndications, funds, notes, what are the common threads of risk investors need to keep in mind?
Good question. Several recurring themes emerged. Market fluctuations, obviously.
Yeah.
Real estate cycles exist. Mitigation. Diversify, stay informed.
Operational issues. Bad management can hurt returns, even if you're passive.
Right. Vetting the manager sponsor is key. Illiquidity. We've hit this hard. Private deals lock up your capital. Need to be okay with that.
Interest rate risk. Affects borrowing, values, refinancing.
Lack of control. You're trusting the sponsor. Due diligence on them is your main recourse. Tax implications. Complex. Need pro advice.
Any others?
Capital call risk in some private deals.
Possibility the sponsor asks for more money later. Understand if this applies, have reserves. Regulatory changes, laws can change. And tenant issues underpinning rental income streams. Strong markets and good management help. So definitely not set it and forget it, even if it's passive. How does someone actually start exploring this? What are the steps?
Logic dictates, starting with your goals. Income, growth, tax savings, diversification. What are you trying to achieve?
Then look inwards.
Yep. Assess your finances and risk tolerance. How much can you afford to lock up? How much risk are you truly comfortable with? Be honest.
Budgeting.
Create a budget for this part of your portfolio. Then educate yourself. Like listening to this. Understand the different vehicles, syndications, funds, notes, pros and cons.
Then match them up.
Select the investment vehicle and strategy that fits your goals, budget, risk profile. Then the big one.
Due diligence.
Conduct thorough due diligence on the deal, the market, the numbers, and especially on the sponsor operator. Check their track record, talk to people, understand their approach.
Probably need help here.
Almost certainly. Consult professionals, financial advisor familiar with alts, real estate lawyer, definitely a qualified tax pro.
And maybe don't go all in on the first deal.
Good advice. Start small if you're new, learn the ropes. Then diversify over time, different deals, locations, sponsors, and finally, monitor and review. Keep track of how things are performing against the plan.
We keep circling back to tax advantages. Let's quickly detail those again with the usual giant asterisk about professional advice.
Right. They can be significant compared to other investments. Depreciation is huge, that non-cash deduction for the building's wear and tear that shelters income.
Can make cash flow tax-free or tax-deferred sometime.
Often, yeah. The 1031 exchange lets you defer capital gains tax by rolling proceeds from one investment property into another like-kind property. Powerful for growth.
Keep kicking that tax can down the road.
Pretty much. There's a potential pass-through deduction, Section 199A, for qualified business income from LPS LLCs, maybe up to 20%. Lower long-term capital gains rates on appreciation if held over a year. And standard deductions for operating expenses and mortgage interest on rental properties. Some crowdfunding deals might offer similar benefits depending on structure.
It sounds great, but that asterisk.
Cannot say it enough. Tax law is incredibly complex, changes constantly, and depends entirely on your situation and the exact deal structure. Get advice from a qualified tax professional who understands real estate before you invest based on perceived tax benefits, please.
Loud and clear. Okay, so you're invested. How do you track performance? How do you know if it's actually working out?
Look beyond just the checks you get. Assess total return, cash flow plus appreciation, or debt paydown for notes, minus fees, over time. Compare to projections and the sponsor's history.
Specific metrics.
For properties, occupancy rates, rent growth, cap rate trends. Is the NOI improving relative to value? For public REITs, look at FFO, funds from operations, their core cash flow measure.
And think about risk.
Always. Risk-adjusted returns.
Yeah.
Was that high return worth the high risk or illiquidity? Compare fees diligently. And scrutinize the sponsor's business plan and projections. Are they realistic?
Constant vigilance, even passively.
You got it. Understand the KPIs for your investment type.
Okay, this has been incredibly thorough. We covered the why, tangible assets, history, lower volatility. We mapped the asset types: residential, commercial, miscellaneous.
We broke down the strategies: distressed, development, opportunistic, value add, core, with that great apartment example.
We navigated the capital stack: debt, preferred, common equity, stressing those key questions. Where am I? How and when do I get paid?
Detailed the private vehicles, syndications for single assets, funds for portfolios, pros, cons, the huge role of the sponsor.
And really dove deep on notes the income potential, but also the serious risks around default, foreclosure complexity, and the intense due diligence needed.
Consolidated the common risks market, operations, illiquidity, rates, control, taxes. Outlined the steps to get started, emphasizing education, vetting, and professional advice.
And highlighted the potential tax benefits with that crucial caveat.
Yeah, the big takeaway seems to be passive investing is powerful. It lets you leverage real estate without being a landlord. But passive does not mean zero responsibility. It doesn't free you from the absolute need for rigorous due diligence on the deal, the market, the numbers, but maybe most importantly, on the people managing your money, their integrity, their track record, their capabilities.
Trust but verify. Know who you're investing with and how it all works.
So maybe the final thought for you to chew on is this. Given the potential upsides of these private passive strategies, the returns, diversification, tax angles, how do you personally weigh that against the downsides? The intense need for operator due diligence, the lockup of your capital, giving up control. What level of passive truly aligns with your comfort level, your financial situation, and what you're ultimately trying to achieve?
Something to really consider as you explore your own path in real estate investing.